Welcome. Today we are going to explore something really powerful that can give you a big edge in the stock market. We are diving into the stock market volume indicator. Now you might be wondering why volume even matters. Well, by the end of this, you are going to understand how volume can tell you a lot about what is happening behind the scenes in the market. So stick around because this could make a big difference in how you read the market and make your trades. Imagine having a secret tool that gives you insight into how many people are actually interested in buying or selling a stock. That is exactly what the volume indicator does for you. Have you ever noticed those bars that appear below the price chart when you look at a stock? That is volume. Those bars tell us how many shares were traded over a specific time period. It might seem simple, but there is a lot that volume can tell us about the strength of a move. When you see a price move on high volume, it means that a lot of traders agree with that move. On the other hand, if volume is low, it may be a sign that not everyone is on board. Volume can also help identify various chart patterns, which can indicate future price movements. Some of the most common patterns include head and shoulders, double tops and bottoms, triangles, and flags or pennants. Let us dive into a few of these patterns and see how volume plays a role. Take the head and shoulders pattern, for example. This pattern is a reversal signal that often appears at the end of an uptrend. It has 3 peaks, with the middle peak being the highest. When this pattern forms, volume is often higher during the formation of the first and third peaks, while decreasing at the middle peak. This decrease in volume at the middle peak shows that buying interest is fading, and when the price breaks the neckline with increasing volume, it signals a strong reversal. Another pattern to watch is the double top or double bottom. These patterns also signal reversals. For a double top, you will see 2 peaks at about the same level, which shows resistance. If the price fails to break through and starts dropping, volume is important. Increasing volume as the price falls from the second peak is a confirmation that sellers are taking control. For double bottoms, the same applies but in reverse. Increasing volume as the price rises from the second low indicates that buyers are stepping in. Triangles are continuation patterns that can signal a price breakout is coming. There are ascending triangles, descending triangles, and symmetrical triangles. During the formation of a triangle, volume tends to decrease, indicating that traders are waiting for the breakout. When the price finally breaks out of the triangle, look for a spike in volume. High volume confirms that the breakout is strong and the new trend is likely to continue. Flags and pennants are short-term continuation patterns that often appear after a sharp price move. Flags are rectangular, while pennants are small, symmetrical triangles. In both cases, volume tends to decrease during the consolidation period, and when the price breaks out of the pattern, a spike in volume confirms that the move is likely to continue in the direction of the previous trend. Understanding these patterns and how volume behaves during their formation can give you an extra layer of insight into potential price movements. Let us expand further on some of these chart patterns and discuss their nuances. One of the most recognizable patterns is the ascending triangle. An ascending triangle forms when there is a horizontal resistance level and the price makes higher lows, indicating that buyers are gaining strength. As the pattern forms, volume tends to decrease, suggesting that traders are waiting for a breakout. When the price eventually breaks above the resistance line, you should see a significant increase in volume. This confirms that the breakout is valid and the trend is likely to continue. It is crucial to watch volume during this breakout because if volume is low, the breakout may not be reliable and the price could fall back into the pattern. The descending triangle is essentially the opposite of the ascending triangle. It occurs when there is a strong support level with lower highs being formed. This suggests that sellers are putting increasing pressure on the price. Similar to the ascending triangle, volume decreases during the formation of the descending triangle. When the price finally breaks below the support level, you should see a spike in volume, which validates the breakout and suggests that a downtrend is likely. If the volume is weak during the breakout, there is a higher likelihood that the breakdown could be false and the price might rebound back up. A symmetrical triangle forms when the price makes both lower highs and higher lows, resulting in a triangle shape that has no clear direction. The symmetrical triangle indicates that neither buyers nor sellers have the upper hand, and the market is consolidating. As the pattern develops, volume usually contracts. The key moment is when the price breaks out of the pattern. Whether the breakout is upward or downward, it should be accompanied by strong volume to confirm the new trend direction. Without high volume, the breakout might be short-lived. Another interesting pattern to understand is the wedge pattern. There are two types of wedge patterns, falling wedge and rising wedge. A falling wedge is often seen as a bullish pattern, where the price is making lower highs and lower lows, but in a converging manner. During the formation of the falling wedge, volume typically declines, indicating that the selling momentum is waning. When the price eventually breaks out of the wedge to the upside, it is often accompanied by a sharp increase in volume, signaling a potential strong uptrend. The falling wedge often appears after a significant downtrend, and its breakout can mark the beginning of a new bullish phase. Traders should look for declining volume as the wedge forms, followed by a breakout on high volume as a clear confirmation. On the other hand, a rising wedge is typically a bearish pattern. The price is making higher highs and higher lows, but the range is narrowing, suggesting that buying strength is diminishing. During the formation of the rising wedge, volume often decreases, indicating that buyers are losing interest. When the price breaks down from the wedge with increasing volume, it can be a strong signal that a downtrend is about to begin. Rising wedges often occur during an overall uptrend, acting as a warning that the trend may soon reverse. Paying attention to the volume trend during this pattern is crucial, as a strong increase in volume during the breakdown signals that sellers are taking control and a larger downtrend may be on the horizon. The cup and handle pattern is another classic chart pattern. The cup forms as the price gradually makes a rounded bottom, showing that the asset is gaining support after a period of decline. The handle forms as a small consolidation following the cup, and the breakout above the handle's resistance is typically a buying signal. During the formation of the cup, volume tends to decline, showing less selling pressure, and as the price moves up to complete the cup, volume should gradually increase. When the breakout from the handle occurs, strong volume is an important confirmation that buyers are stepping in and that the trend will continue upward. In addition to these, the rectangle pattern is a useful continuation pattern to recognize. During a rectangle pattern, the price moves between parallel support and resistance levels. This pattern represents a period of indecision where buyers and sellers are in balance. Volume tends to decline during the formation of the rectangle as market participants wait for a clear direction. When analyzing a rectangle, it is important to observe the duration of the pattern. The longer the rectangle persists, the more significant the breakout is likely to be when it occurs. A breakout from this range, whether upward or downward, is more likely to be successful if volume increases significantly. High volume during the breakout signals that the market is committed to the move, adding reliability to the direction. Low volume during the breakout may indicate that the move lacks conviction and the price could return to the range. Often, a retest of the breakout level with strong volume can further confirm the validity of the move, giving traders a better entry opportunity. Combining volume analysis with chart pattern recognition can significantly enhance your ability to predict market direction and make better trading decisions. Volume is the confirming force behind these patterns and adds a layer of reliability to the signals you observe. The more you practice identifying these patterns and correlating them with volume changes, the more proficient you will become at reading the market and executing successful trades. Imagine you are watching a stock that is climbing higher and higher. If the volume is increasing with that price, it is telling you that more and more people are buying in. It means the uptrend has real support. But what if the price is rising and volume is not? That could be a warning that the move might not have as much strength as it seems. It could even reverse. This is why volume is such a great tool to have in your trading strategy. It gives you a peek into how much strength is behind a price move. Volume can also tell us a lot about what traders are feeling. Let us think about what it means when there is high volume during a price drop. That usually means that there is a lot of selling pressure and people want to get out of that stock. High volume during a decline suggests a strong conviction among traders that the price should move lower, which often means that the downtrend is likely to continue. If you have ever felt unsure about a trade because the price is falling but volume is low, it could be a sign that the drop might not last. The low volume means not everyone is selling and the move could be weak, indicating a lack of conviction. This could lead to a reversal or a consolidation period before the price picks a more definitive direction. Volume is one of the best ways to gauge the emotion of the market because it represents the level of participation and consensus among traders. A strong move accompanied by high volume suggests confidence, while low volume indicates hesitation or uncertainty. There is something else about volume that is really worth paying attention to, and that is volume spikes. A volume spike is when you see a sudden jump in volume that stands out from what is normal. These spikes usually mean something big is happening. Maybe there is a breakout or maybe a reversal is starting. For instance, if a stock is breaking through a resistance level and you see a huge spike in volume, that is a strong sign that the move is real. The high volume tells us that a lot of traders are jumping in. Now, if you want to use the volume indicator, the first thing you need to do is get it on your chart. Most trading platforms make this pretty easy. You just open up your chart, go to the list of indicators and select volume. Once you add it, you will see those bars at the bottom of the chart. Each bar tells you how many shares were traded during that time. The higher the bar, the more shares were traded. You can also change the way the volume bars look on your chart. Sometimes making the bars thicker or changing the colors can make it easier for you to spot changes in volume quickly. Customizing your chart is all about making it work for you. If you have used other indicators before, try adding volume and see how it helps. The more comfortable you get with reading volume, the more it will help you make sense of what is happening with price action. One of the key things to understand about volume is how it confirms price trends. When a stock price is going up on strong volume, that is a good sign that the trend is likely to continue. Strong volume during an uptrend suggests that there is broad support for the move, meaning many traders are participating, which increases the reliability of the trend. Conversely, when you see the price rise but volume is dropping off, it could be a warning that the uptrend is running out of steam. This indicates that fewer traders are willing to buy at higher prices, and the rally may be weakening. This kind of information is really useful when you are deciding whether to enter or exit a trade. For example, if you are already in a position and notice that the price continues to rise on decreasing volume, it may be a good time to consider taking profits or tightening your stop loss to protect against a potential reversal. Let us look at a downtrend now. If a stock is falling and volume is high, it shows strong selling pressure. This usually means the trend will continue. But if the price is dropping and volume is low, it might not last. Sometimes traders will jump out on a quick dip, but without high volume to back it up, it is often not a strong downtrend. So how do you think volume plays into your trading decisions? Are there times when you have been unsure because of the volume you saw? One of the most exciting ways to use volume is during breakouts. When a stock is testing a key support or resistance level, volume is the thing you want to watch. A breakout with high volume is more likely to keep going because it shows that traders are excited about the move. On the other hand, if a breakout happens on low volume, it might be a fake out and the price could come right back. Paying attention to volume during these times can save you from getting caught in a false move. Sometimes a stock will move sideways for a while in what we call consolidation. During these phases, you will often notice that volume drops off. Traders are waiting for something to happen. When the price starts to move again and you see the volume pick up, that is often the start of a new trend. This can be a great time to get in early on a trade. Are you ready to start watching for these moments? Volume works really well with other indicators too. One combination that is really powerful is using volume with moving averages. Moving averages are useful because they help smooth out price action and reveal the underlying trend. When you combine this with volume analysis, you can add an extra layer of confirmation to your trades. For instance, if you see the price above a moving average and volume is rising, it can be a strong sign that the trend is healthy and likely to continue. The rising volume shows that traders are actively supporting the move, which makes the trend more reliable. On the other hand, if price moves above a moving average but volume remains low, it might suggest that the trend is not as strong as it appears and could lack the momentum needed to continue. Another useful combination is to use volume with exponential moving averages, or emini. EMAs place more weight on recent price action, making them more sensitive to changes. When a price crosses above an EMA and volume spikes, this can often be a strong entry signal, as it shows that recent price action is being supported by new buying interest. Conversely, a drop below an EMA on high volume could be a good indication of a trend reversal. By watching both the price relationship to moving averages and the corresponding volume, you gain more insight into whether the move is likely to persist. Another great technique involves using multiple moving averages of different time frames along with volume. For example, you might use a short-term moving average, like the 20-day moving average, alongside a longer-term average, such as the 50-day moving average. When the short-term average crosses above the long-term average, often called a golden cross, it is a bullish signal. If this crossover happens with rising volume, it is a very strong indicator that a new uptrend may be beginning. In contrast, If the short-term average crosses below the long-term average, known as a death cross, and volume spikes, it often signals that a strong downtrend is starting. Observing volume during these crossovers is key to understanding the strength behind the move. Another great pair is volume and the relative strength index. The relative strength index, or RSI, can help you see when a stock might be overbought or oversold. If RSI says a stock is overbought, but volume keeps climbing, it might mean the uptrend still has more to go. Using multiple indicators together gives you a more complete picture and helps you make better decisions. When the price gets close to a key level, whether it is support or resistance, you should pay special attention to volume. High volume near these levels often means that something big is coming. Either the price will break through or bounce back. Knowing how to read the volume during these moments can help you decide what to do. Let us go over a few examples so we can see how volume works in action with different chart patterns. Imagine a stock is trending up and you notice that the volume bars are getting larger. This tells you that more traders are buying in and supporting the trend. This could be a great time to either buy or hold your position because it shows strength. For example, if the stock is forming an ascending triangle and you see increasing volume as the price approaches the resistance level, it is a strong sign that the resistance is about to be broken and the trend will continue. Now think of a different scenario. Let us say a stock breaks above a resistance level, but the volume is really low. That could mean that not many traders are jumping in, and the price might fall back down soon. This is common in false breakouts, where price briefly moves above resistance only to fall back below it because of a lack of conviction. Recognizing these moments can really make a difference in your trading results. Consider another scenario involving a double top pattern. Imagine that a stock attempts to break above its previous high, forming the second peak of the double top. If the volume is decreasing as the price approaches this level, it can indicate that buying interest is weak, making it likely that the price will reverse. On the flip side, if the volume is rising significantly during the decline after forming the double top, it confirms the bearish reversal, suggesting that sellers are in control and the downtrend is likely to continue. One more example involves a symmetrical triangle. If a stock price is consolidating in a symmetrical triangle pattern and volume is decreasing, it means traders are waiting for a breakout. Once the price finally breaks out, whether upward or downward, a significant increase in volume will confirm the direction of the new trend. Without the volume spike, the breakout could be a fake out, and the price may move back into the triangle. Understanding how volume interacts with these patterns is crucial for making informed trading decisions. There are some common mistakes that traders make when using volume. One mistake is relying on volume without considering price action. Volume alone cannot tell you everything. You need to look at what the price is doing as well. Another mistake is getting too caught up in volume spikes. Not every spike is important. Look for consistent trends in volume instead of reacting to every big bar that appears. What do you think about these mistakes? Have you ever made them yourself? Adjusting how you use volume based on the market condition is also key. In a trending market, volume can help confirm how strong the trend is. If prices are rising and volume is also rising, that is a good sign. If prices are falling and volume is high, it shows that the selling pressure is real. But in a range-bound market, volume can help you spot when a breakout might happen. Rising volume near support or resistance often means that something big is coming. Are you starting to see how this could change the way you look at the market? To wrap up, remember that the stock market volume indicator is one of the most useful tools for confirming trends, understanding market sentiment, and spotting potential breakouts. It is best to use it alongside other indicators and always with price action to make the most informed decisions you can. The more you practice, the more you will see how volume can give you an edge. Keep experimenting with volume on your charts and keep refining your approach. The more you use it, the better you will get at reading what the market is telling you. Remember, trading is about practice and patience. So start using the volume indicator today and see how it improves your strategy. Thank you for joining me and happy trading.